everyone. Here we are back with another episode of Let's Talk Real. How are you doing, Kelly?
I'm very good. How are you?
Very good too. Just kind of changed things up a little bit because our schedules didn't collide this time. So we moved it to Wednesday. So hopefully you guys are still able to join us today. If not, you can watch the replay. But today, as promised, we're going to be talking all about USDA loans. Kelly's going to be helping us understand a little bit when it comes to the financing side, and I'll chime in with a little bit on the real estate side, so you guys can have a full understanding of what is USDA, what is it about, who can qualify for, if there's any limitations, pros and cons. We'll go over all of it for you guys. But just to recap what we had last episode, Kelly, can you give us a little summary?
Yep. Last episode, we talked about FHA loans and all the benefits and all the pros and cons of FHA. FHA is a great first-time homebuyer product. A lot of first-time homebuyer loan products usually coincide with FHA, with it being government. The credit, when the difference between FHA and a conventional loan, conventional is tough on your credit, but easy on the property, whereas FHA is easy on the credit when qualifying a borrower, but they're harder on the property. That's the best example I can give with a comparison so people understand, well, why should I go FHA versus conventional?
Yeah.
Well, if you're a first-time home buyer, it might make sense to go FHA because you're just starting to build your credit, starting to save money, and FHA is very, very lenient on a lot of things when it comes to credit. It's the property. They are very strict on the property, so they don't want to see FHA appraisals. They don't want to see steps that don't have a railing. They don't want to see chip paint. If the house was built prior to 1970, they want to make sure there's no lead paint in the house. Like there's a laundry list of things that they will look for in the home itself. But it is a great program. I do sell a lot of them. A lot of people use the FHA loan, but I think that pretty much kind of sums up. I'm not going to go into too much detail with that, but
if you missed it out, just watch our last episode. We talked all about it in more detail. And we actually went even over a little bit of time because there was a lot of good info to be shared about the FHA loans. But so not to delay today's topic, so we're going to get into the myth of the day in regards of the USDA loans, which we have a couple today. We're going to talk about this one, which I think is the biggest misconception about USDA loans, because they hear USDA is, Department of Agriculture, so they automatically assume that it's only for farmers or farms or homes that are underdeveloped. But that is not true, right, Kelly?
Correct.
Yeah. So
correct.
You can give us more insight then on, what are some of the qualifications, very summary until we get into the topic. But
yes, so as far as the property is concerned, if the property is in a rural area, then most likely it's going to be an approved USDA property. If anybody is thinking about going USDA because they've heard about it or they know the details and the benefits, there is a website that the first thing I do is I go on the USDA website to make sure that property is an approved rural area.
Correct.
If you're looking to live in the city, you're not going to
forget about it.
No USDA loans in the city.
No.
There are certain outskirts of the city that aren't considered rural that most likely wouldn't be an approved property. But again, it's a very easy thing to find out if the property is approved under USDA. And so they're really looking for a rural area where it's not so much a city life. No rural, no USDA loans for the city.
Exactly. Yeah. And that's very true. So this is a myth, a misconception that people think is just farms, but it's not. And there is, like you said, an eligibility map that we can go and check out the areas that are USDA eligible. And believe it or not, for us here in our local area, pretty much if you take the city and then you just go a few miles out, it's USDA eligible. Like there's parts of Mechanicsburg that are USDA eligible. Carlisle is actually part of USDA. If you go past, like there's a section between Harrisburg and Hershey that is USDA eligible. So if you want to be on the outskirts there, like around Hummels now, you might be able to find something that
I believe Harrisburg just added some areas that are now USDA approved.
Yeah, they've kind of shortened the limitations. The seed is still completely out of the picture, but you have like if you go towards Fishing Creek in the mountains, that's actually part of USDA now as well. And just so you guys kind of know, the idea that we're talking about USDA that a lot of people want to try to venture into it is because it's 100% financing. So it's right there with like a VA loan for military personnel where you don't have to put a down payment. So that's why a lot of people are interested, but you do have this area limitation. But yeah, it's becoming more and more of a broader area that we can be looking at as soon as you are okay not being in the city. Because every city area, it's not going to be eligible. The West Shore, half of the West Shore is basically out of the picture. York City is out, Lancaster's out, but then everything around it, like Mayheim is part of it. So you can buy a house in Mayheim with a USDA loan. So there's really good areas that are very near the city, but they're still eligible for the USDA.
Yep.
So, yeah. So I guess that explained this myth. We're going to have another myth coming out, but this is like the starter one for us to get into the topic. But let's get into it then. So you want to give us some like starters of what is USDA exactly? I can tell you guys that is a United States. I had to look this up. I did not know, but it stands for United States Department of Agriculture, and that's why this misconception happens a lot. But it's just like what we just talked about. It's for rural areas. That doesn't mean it's farmland, right? Kelly can give us some more insight on maybe the criteria. We can get into that.
Yep. So I don't want to. So pretty much what we just went over with the USDA, I would consider USDA loans one of my first-time homebuyer programs, just because it is 100% financing.
Yeah.
And all depends. What's that?
It's cheaper in that sense, right?
It is cheaper in that sense, and it falls in the line with a lot of first-time homebuyer programs. They have income limitations, but they're easier on the credit. This is also another government loan, so where they're a little bit strict on your debt to income ratio. It's the back end can't go over 41%. So that's a dead stop there. However, they're a little bit easier on, the first time home buyers who don't have the best of credit. They're used to actually the mid credit score for USDA loan, and I lied a little bit, is a 640. So it doesn't go as low as FHA, but it has to be a 640 or above, which is kind of like a median amount for the FICO. But again, with it being what I term it as first time home buyer, it's it's like there's limitations to the income. So when you're a first time home buyer, your income usually isn't, you're not making millions of dollars. So there are income limitations, and that depends where the house is. It depends on the customer. And those limits depend on how many are in the household.
Correct. Yeah.
And that means so the more people in the household, the higher the income limit is.
And mainly because they do count everybody's household income.
They count everybody's household income, but if they have 5 kids versus a family who only has maybe 2 kids, the income limit's going to be higher for the person with 5 kids versus the person with 2 kids. Right. So, and the 100% financing is huge. They don't have to put any money down, but they do have to come up with their closing costs. And USDA when you finance into a USDA loan, you have your base loan amount, but then you also have your USDA loan amount. And there's always a USDA fee that gets financed in with the loan, which I believe is 1% of, in most cases, the purchase price, because they're not putting any money down. So
Yeah.
let me see if I have that number written
Which
down.
I believe that is a lot less than the mortgage premium that you have to pay when you're using an FHA loan.
Correct.
So technically, this is a cheaper loan with a little more stricter guidelines as for the debt to income ratio and the limit on income potential there.
Correct.
Yeah.
And some of the other quick things for first-time home buyers there's no reserves that are required for it. A lot of times, I think FHA might even require some reserves, but you know, with conventional, they want you to see that you have at least a couple months reserves in your bank account after the loan settles. When it comes to student loans, if you have any outstanding student loans that are deferred for payment, they only count 0.5% of the outstanding balance as part of the debt. So pretty much on any of our products, we have to count a payment in there. Conventional, Fannie's 1%, Freddie's 0.5%, but USDA is only 0.5% of that outstanding balance. So, I mean, that kind of sums up a lot of what helps with first-time home buyers, because a lot of first-time home buyers, they don't have reserves sitting in their account. So
yeah, that's true.
You know,
we barely make it.
Yes. Believe me, I wish I would have known about USDA back when I was looking for my house. So I didn't know that wasn't one of the products I sold at the time. So,
yeah. It is a great program. As soon as you fit the criteria, it is actually a pretty good.
It really is.
For people that cannot go like military and get the 100% conventional. 100% financing with the USDA, that can be a possibility depending on the area you're looking at, which is great.
It is, and I try to talk to a lot of people about it, but they are strict on the property because, again, it is a government loan. There's no extra inspection required, but it would be considered a USDA appraisal. So they're going to be looking for kind of similar things that FHA is looking for in the property. So they are going to be a little bit more strict on the property versus a conventional loan. But, you know, there's that benefit of 100% financing where you don't have to put any money down. So there are, like I said, there are income limits, but that, you know, goes into play with, you know, where the property is, you know, how many are in the household. There's a lot of things that, and I don't know what that income limit is because we have two separate systems that we work with. So we have our application, then we have to upload it into the USDA system. And as soon as we do that and it has all the income in there, it will tell me immediately what the income limit is. So I'll know right away if they would qualify for it or not. So that's also a nice thing to know. Because if they don't qualify, then we're done, and then we just kind of move on to the next product.
Other alternatives, right? Which there are so many different options available nowadays to buyers, different programs. Soon we're really going to be able to talk even to more of them. But there's quite a few options out there. So talking to Kelly will kind of clarify what's available to you specifically. Because we're here talking about these different types of loans. But really, when it comes down to it, when you talk to Kelly, she's going to let you know exactly which one is the best one for your situation, you know, which one's going to be the most financially reasonable or for your budget that fits your budget. So she's going to take a look at everything and let you know, okay, you should probably take a look at this route versus this route, but this is the difference, right? Usually that's what we do when we do our initial consultation.
Yep, everybody's story is different. So, you know, what works for one isn't going to work, may not work for somebody else. But again, you know, it all depends on where you're at. If you're looking to, maybe you don't have a whole lot of money, but you really want to buy a house, but you may have enough for the closing costs, but you can also get seller assist. with
USDA.
with USDA. So that is also a thing. So even if you really don't have that much, you don't need the reserves. You can get seller assist that can help pay for the closing costs. So you're kind of, it's a great product if you fit into the guidelines.
Yeah, and is there a minimum amount that the buyer needs to pay out of pocket on a transaction with USDA? I can't remember if there was a minimum.
I think there might be. It's a small amount though. I don't know
like
what that is offhand.
Because there could be, we could find ourselves in the great situation where, since you don't have a down payment, it's 100% financing, and you only have to pay your closing costs. But then we're using USDA. I can negotiate on your behalf to get up to 6% seller's help, which actually could put you in a situation where you're upside down, where you could be getting money back as settlement, which I don't even know if it's allowed with USDA, but you wouldn't have money out of pocket unless there is a minimum requirement, which I believe is about $1,000. But I have to double check on that.
Yeah, I have to double check on that too, because I believe there might be a minimum that does have to come out of pocket for.
It's either 1,000 or 1%. I can't remember. It's either or.
Yeah, it might be either or, whichever is the less. Is the greater?
Yeah. Because I don't know if they make a requirement for you to pay at least a fee out of pocket. I don't know. I have to double check. We'll get back to you guys.
When I was going through all my stuff, I didn't see that because I didn't see that requirement when I was writing down my notes.
And I can't remember from the top of my head.
Really, and the last time I did one was like a long time ago, so I don't remember what that requirement. But I believe there is. I believe it is either 1% or $1,000, whichever is greater.
Yeah. Which will be a great situation to be in, right? Because then basically your deposit that you give it on the house whenever your offer is accepted basically is the amount you have to put down, and that's it. You come to the settlement table 40 days later or 30 days later, and you just come to sign. You don't have to bring any more money. That's like the beauty of not having a down payment and having the seller's assistance in place covering your closing costs. So that could potentially happen. So when someone comes to us thinking they can afford, honestly, if you can afford the monthly payments and approve, you potentially could actually buy a house with almost no money out of pocket, because that can happen. The situation can happen.
Yep. I was gonna say something. I completely left my brain.
Was it about the down payment or?
I don't even know.
That was me. Sorry, I kept talking.
No, it was about what you were talking about, and I was gonna add on to it, and now I don't remember. So, but it's okay.
Well, why don't you talk about the second myth that we had that you brought it up? Because you run into that a lot. So tell us.
So I've been asked many times when I bring up USDA, I've had some. And this has come from realtors and borrowers. I've had people ask me, they're like, well, I thought USDA was running out of the funds. And I'm like, what do you mean? When somebody first asked me that, I was like, what's that?
We think it as if it is a grant, right? And that's not what it is. It's a type of
So there's two types of funds that you get from USDA. So you can go to USDA Direct, which USDA Direct can run out. They do sometimes run out of funds, or they get low on funds. However, most mortgage companies, and we use what's called USDA guaranteed funds. So the money is always there. And most lenders, like I said, if you go through USDA Direct, there's a good possibility that there may not be enough in USDA Direct for you to finish out the loan. But most mortgage companies go through USDA guaranteed funds. So the money is always guaranteed. They don't run out of money. So that is definitely a myth when it comes to USDA.
Yeah, I never actually ran into that, maybe because I knew of it and how it worked. So I did not know, though, it was two types. So that might be why some people thought that. So
I've had more realtors make that comment to me than buyers. And the only time a buyer makes a comment to me about it is because the realtor told them that. So
because usually the buyers are not necessarily going to know other
No,
Americans?
no, because I asked them like, well, where are you getting your information? They're like, oh, well, my realtor told me. I'm like, well, okay. But yeah,
You need to get more instruction. You might
Yeah.
need to get a better realtor.
Well, and I guess it all depends too on their background, their history.
Yeah.
If they've never done a USDA loan, maybe they only know about USDA Direct, and that's
That is
okay
true.
too.
That is true.
Sometimes I send people to USDA Direct because I can't get them to fit into my criteria, and sometimes that's the only option.
Yeah. And then that's when they have the possibility of not having the funds available at that point.
Yeah.
Interesting.
So it's a good product for sure.
So we did touch base a little bit on the eligibility requirements for someone wanting to get into, using USDA as an option. Do you think you can give more detail? Did you bring some information about more in depth on the requirement criteria?
Well, the main things on the requirement are like, so that the credit score 640 or above,
Okay.
the ratios, the front end. So the ratios are to be 29 and 41. That 41 back end ratio, that's kind of like a dead stop. You're not going to get
Any further than that.
They do. So with USDA, they can do a manual underwrite if it goes, I believe, up to 44. With the manual underwrite, they would require to see. So if you're renting, they would want to see a 12-month history of the rent being paid on time. And there's some other criteria that falls into the manual underwrite, that some additional things that the underwriters would request. And so the 1% of the purchase price is what the loan amount ends up being. So there is a loan limit. The loan limit is $336,500.
Okay.
If you meet that criteria. So that is something else too. Like, so it has the income limits that get calculated, when you first put the information in their system, and they'll tell us what the income is. Like I said, there's no one set amount.
There is, and that's why I was like, it's kind of hard to tell, because I think they use a percentage. It's like
they do, and I don't know what that is, because every time I've done a USDA loan, I put it into the system. Like, it all depends on the area, the house, the borrower. Like, there's so many things that come into play with that loan limit. There's no like dead set amount that it's this amount.
Yeah, they don't have it set as like one person this much, two people. It's not like that, which is interesting. So that's why whoever is interested needs to reach out to you, Kelly, to be able to really find out whether they can qualify or not, because it's just, you never know. There's no set table per se for that income limitation. And one thing that was interesting too, and mainly because I work with a lot of people that are not from the U.S. and maybe are non-U.S. citizens, or they have a green card, a permanent residency card. You are eligible to use USDA if you are a non-U.S. citizen and have a green card, permanent residency. You are eligible for that. So just as an FYI, I don't know if the other loans, whoever brought that up, if you were eligible or not.
No, because most of our loans, as long as you're able to show your green card or your working visa, most of our loans allow you to
purchase,
to participate in those loans, just because if you're able to show proof of it, then yes, most likely we can.
So if you are not a U.S. citizen, don't be discouraged that you can use these types of loan programs, because you can actually use your green card and purchase a home here in the U.S. with normal, regular loan types like these.
Yes. Yep. And so pretty much as far as any other, there's really nothing else. I think we need to get the full tax returns when doing a USDA loan versus just like W-2s.
Oh, okay. That's
they want
different.
to see, yeah, they want to see the full return. I do know that for sure because I remember running into problems getting that from some people.
For the
But yes,
full, yeah.
so to do a pre-approval, I would get just the W-2, but USDA, because USDA, so once the file is clear to close, we have to run it through the USDA system at least 3 days prior to closing. So they want to see the full returns. They want to see all this stuff.
Yeah. So it's basically double underwritten in a way, right?
It is, yes.
Because it gets to be seen by 2 people for final review.
Yep.
Yeah.
Yeah, and I think that pretty much covers it. I mean, we can go over the pros and cons.
Yeah, we can summarize it because I think we pretty much mentioned all of them. If you want to go over the cons, since we're pretty much, I think the other double underwritten is one that we didn't put it down, but that's kind of like a con because it can add time to the settlement time frame.
Yeah.
I would say USDA's on average you see between more like 45 and 60 days, while a conventional loan you see 30 to 45 at most.
Yep.
So I think that's the one con. But if you're not in a hurry, I guess it doesn't matter.
Right.
Yeah.
So I would say the cons, you're restricted to the demographics, like which, rural area. So you can't, no buying in any cities with USDA.
Yeah.
You do have your income limits with USDA. And again, that all depends on the area you, like I said, if there's the more people in the household, a lot of times it does increase limits, but it also, even if not both individuals are going to be on the loan. So say you have a husband and wife, but you only need the husband's income to qualify for the loan, and the wife works, you need to count both the husband's income and the wife's income, and it has to meet that 40, like I said, it can go up to 44% on the back end for a manual underwrite, but you have to meet those guidelines with all income in the household.
That's right. Yeah.
So that 41% DTI is 41 to 44 is a hard stop. And it has to be
for some people.
Yes.
Yeah.
And it has to be a primary residence only. So you can't use USDA for second homes, investments, rentals, that kind of thing.
Yeah.
So I think that covers my cons. Did you have any to add to it?
I think one that maybe we didn't have it down, but it was the mortgage, the premium the fee that you have to pay for USDA that gets rolled into the loan amount.
Oh, the 1%. Oh, the 1% fee. Yes.
Which I mean is actually pretty low in comparison to FHA.
Yeah.
But I would say this is still a con because it's still a fee that you have to pay. So I guess we can add that as a con.
Yeah.
So it's the mortgage premium there.
So you have your base loan amount, but then you have your USDA loan amount, which is 1% higher than
the purchase price.
Whatever. Yep.
Yeah. So to kind of give an example, if you're buying a house at $200,000, is 1% fee. So you're buying the house at $200,000, but your loan amount is going to show up as $202,000 because again, you're 100% financing, and then you have the fee on top of that, which is 1%, which is $2,000. So that's what Kelly means when she mentions on top of the loan. So your loan amount is actually going to be higher than your actual purchase price amount.
Correct. So when you see a fee estimate or a pre-approval for a USDA, you're going to see a base loan amount, but then you're going to have the actual loan amount is going to have that fee included with it because it gets financed. So you don't see it in your fee schedule. Or not your fee schedule. You don't see it in your payment schedule. You'll see your principal, interest, your insurance, and your taxes, but you won't see that fee in there because it's just financed into the loan. Yeah,
it's part of your principal technically. So you won't see that differentiated. You see your mortgage insurance, your primary mortgage insurance, but you won't see this fee because it's built into your loan amount.
Correct.
Yeah. So I guess that would be the last con that I can think of.
Okay.
Yeah.
So in the pros I have, so no down payment.
Yep, that's a big one. That's a big pro.
So no cash reserves.
Yep.
They are flexible on the credit with qualifying. They're not as hard on you for credit. The seller can pay for your closing costs because you can get up to the 6% of the
Yeah, we can
purchase
go
price.
all the way up to 6%. There's no restrictions like with the conventional. When you put less than 10% down that we mentioned, that is 3. USDA is all the way to 6.
Yep. And I can't read my handwriting. Oh, and it's good for, I think you had this in your, good for a purchase, a refinance, or a build. So you can use it for any one of those
options. Yeah, which it was interesting because when I was doing some research on the USDA, I didn't know that you could use it for building as well. There's a certain way that they do it to make it.
You have to be careful with the build, though, that you don't go over your limitations.
That's right, because 330 something, right?
I personally would not use it for a new build, only because I did so many construction loans where people always go over what they think they're going to go over. At least 10% over. So I would say
you kind of build that into your max, right? That way you're not passing that, which unfortunately nowadays with new construction, it's kind of hard to stay under the 330s. Like we're not seeing that much of that in our area anyway. If you're building a new home, you're probably starting at 300.
No, believe me, when I started doing mortgages 20 years ago in 2003, I was a construction loan specialist. And I don't know that I had a single customer that did not go over their build amount. I really don't.
It's just so tempting. You can get everything you want the way you want. So
and then when it's being
built, I just don't build the right way.
Well, when it's being built, things happen and and we get to the end and I would have to refinance people because they added so much throughout the build. And I'm like, I told you to put 10% in there. But anyway, that's
your recommendation of the day, right?
Yes.
Your advice.
10%. Always add 10%. I think that pretty much covered it. USDAs are really good. If you fit into the bucket, then it's a good one.
I know. Yeah, that's a good one too. Yeah, I don't have anything else to add. So I guess this is it for us for today. If you guys have any questions, and I think, let me just double check here. Hello, Billy. So Billy stopped by, say hello. But yeah, if you have any other questions for us, please let us know. We'll be happy to help you in any way we can. Our informations keep going down here at the bottom. You can call us, message us, email us, hit us up on social media. And please, if you are watching this on YouTube, subscribe, like, and follow us.
Yes.
We love the support. So that's all I have.
Yep. Have a great night, everybody.
Thank you, guys. Have a good one. Bye.